You think you know the AI arms race? Think again. For years, one company, Nvidia, has ruled the $4 trillion battlefield, selling the GPU engines to everyone, collecting a massive tax on every AI breakthrough. But everything changed in late 2025. We've just witnessed a direct, full-scale attack on that empire. Google didn't just build a better chip, they built a better system. And when they launched their merchant silicon strategy, selling their specialized TPUs to rivals like Meta Platforms, Nvidia's stock tanked. While other tech giants bled, Alphabet's value exploded. Today, we're diving into the real story. How Google's vertical fortress training its own Gemini 3 models on its own chips makes them a financial powerhouse that defies the AI bubble. We'll show you the specific chip specs, Blackwell versus Ironwood, and the hidden economic war being fought over cost per token and power efficiency. The monopoly is broken. Find out who is spending smarter and why Microsoft and Meta are allocating 35% of revenue while Google keeps it at 23%. This isn't just about microchips. It's about the future of finance, cloud computing, and AI supremacy.
Hit that subscribe button and let's break down the biggest strategic pivot in tech history. You don't want to miss this. Okay, let's unpack this. We have to start with the sheer scale of the money pouring into this, because that's really what's driving this whole AI bubble fear.
Oh, it's staggering. It really is. If you just look at the first 9 months of the year, you have 5 of the tech giants. We're talking Alphabet, Microsoft, Amazon.
Meta and Oracle.
Right. And combined, they've recorded a capital expenditure of $321 billion.
$321 billion.
And, to put that in perspective, that is nearly triple what those same companies were spending in the same period just 2 years ago.
Yeah.
It's an unbelievable acceleration.
And for the longest time, almost all of that money had one destination, Nvidia. Their GPUs, which, were originally for video games, they became the engine for AI. But the real secret weapon wasn't just the chip itself. It was CUDA, their software platform, that just locked everyone in. It created this ecosystem that let them charge what people started calling the Nvidia tax.
Exactly. But then something shifted, right? In late 2025, the game just fundamentally changed. The market, the investors, they stopped just rewarding companies for, spending a ton of money.
Right.
They started looking closer, trying to distinguish between companies that were just buying the gear and the ones who were strategically controlling it.
And you could see that play out on the stock market almost instantly. After that NASDAQ high in late October, you saw Microsoft, Oracle, Nvidia, Meta, all taking these double-digit dives.
But not Alphabet.
Their stock jumped something like 16%.
And that wasn't an accident. That was a clear signal to the market that Google or Alphabet had this deep level of vertical integration with its AI.
A fortress, basically.
A fortress is a good word for it. It was so complete that it could, in theory, insulate them from the chaos and the high costs of the wider AI bubble. They weren't just a customer anymore, they were the factory.
And that all traces back to a really fundamental choice they made years ago in hardware philosophy. You can't understand the money without understanding the chips, right? The GPU versus the TPU.
It's a classic story, really. Versatility versus specialization. NVIDIA's philosophy is all about versatility. The GPU is a general-purpose tool. It has thousands of these CUDA cores.
So it can do anything.
It can do anything. Graphics, science simulations, any kind of AI model you throw at it. And CUDA just reinforces that flexibility.
But Google's TPU, the tensor processing unit, it's the exact opposite.
Completely. A TPU is what we call an ASIC, an application-specific integrated circuit. It is built to do one job and one job only.
Matrix multiplication.
The tensors. It's the absolute computational core of deep learning. So yeah, it's way less flexible than a GPU, but for that one specific repetitive job, my God, the efficiency in terms of performance per watt is just off the charts.
Yeah, we used to think of the TPU as, this interesting side project. But if you look at the modern specs Google has, they've more than caught up. You've got NVIDIA's B200 Blackwell against the TPU V7 Ironwood.
And on paper, they look incredibly similar. Both chips have a massive 192 gigabytes of high-bandwidth memory HBM3E.
Okay, so memory parity. What about bandwidth?
That's also super competitive. The B200 Blackwell gets you about 8 terabytes per second. The Ironwood is right behind it at around 7.2.
So if the specs are so close, what does that 0.8 terabyte per second difference really mean? Is Blackwell just better?
Not necessarily. That's where you see the design philosophy come into play. Blackwell is a general-purpose beast. It's great for complex, varied tasks like training or simulations.
Right.
But Ironwood is a specialized sniper. It's been maximized for inference, for actually running the huge models like Gemini or Llama once they're built, and that's where most of the operational cost is. So Google is targeting the biggest expense.
And it's not just the chip, it's how you connect thousands of them together. That's the real challenge at scale.
That is the ultimate challenge. Blackwell uses NVLink, which is fantastic, but Ironwood uses Google's own custom optical interconnect, their OCI.
Which is designed for what?
For massive, power-efficient scale. It lets them build these single computing pods with, like, over 9,000 chips in them. When you design the chip and the network that connects them, you control everything. You minimize latency, you maximize throughput. That's real vertical integration.
So that's the how. They built the tools. How do they use these tools to build that vertical fortress you mentioned, the thing that protects them from the market?
Well, they just started looking at the AI race as one big integrated design problem. It's like most companies in this space are buying parts off the shelf from Nvidia, right?
Mm-hmm.
Google decided to design and build the engine, which is the TPU, the factory floor, which is the network, and the final car, the AI model, all in-house. It's like they're OpenAI, Microsoft, and Nvidia all rolled into one company.
And the proof of concept for that entire strategy was the Gemini 3 model.
That was it. Gemini 3 was trained from scratch, completely on their own self-sufficient infrastructure, in-house TPUs, in-house networks. That specialization just means their chips are inherently more energy efficient and, more importantly, more cost-effective than buying GPUs at a premium from someone else.
And the market started to notice even before the big news broke. You started seeing these little cracks appear in the Nvidia monopoly.
That's right. The deal with Anthropic was a huge early signal. Anthropic makes the Claude model, and they announced a plan to buy up to 1 million Google TPUs.
A million.
A million. That single deal is projected to need about 1 gigawatt of computing capacity.
A gigawatt is a number that's hard to wrap your head around if you're not in the data center business. What does a commitment of that scale actually signal?
A gigawatt is a city's worth of power. For a major AI player like Anthropic to commit to that scale with Google's custom chip validates two massive things. First, that the TPU is ready for prime time and it's scalable. And second, that the economics, the lower running costs, were so good, it was worth leaving the comfort of the Nvidia ecosystem. It was the first big external proof that Google's strategy was working.
And on top of that, Google had this secret weapon for distribution that nobody else could really match, especially not a startup like OpenAI.
Their core business. They run 90% of the world's internet searches. There was a TD Cowen survey that showed in October, Gemini usage went up 2 percentage points to 26% of users, while ChatGPT actually slipped a point.
Because they can just bake it right into search and Android?
Instantly. They can distribute their models to billions of people overnight. It lets them catch up incredibly fast, no matter what kind of head start someone else has.
Which brings us to the moment that really sent a shockwave through the entire $4 trillion AI market. The reported talks in late November between Google and Meta.
Yes. This was the big one, because this wasn't a startup looking for a cheaper deal. This was a hyperscaler, one of NVIDIA's biggest customers for years, seriously considering an alternative.
And that news alone created what people are calling the NVIDIA shockwave.
It was immediate. Just the idea that Meta might move some of its massive budget away from NVIDIA GPUs sent their stock down, 7% in early trading? It proved the threat was no longer theoretical. You could now put a dollar amount on the damage.
And analysts were pointing out that the concern went way beyond just losing one big customer.
Oh, absolutely. The worry was about the precedent. If Google could successfully sell its specialized chips to a giant like Meta, it meant there was now real price competition in the market. As one analyst said, Google winning would actually hurt several stocks we cover.
In other words, the party was over. The days of premium pricing were numbered.
That's it. And while Nvidia was reeling from that shock, Google's stock just kept climbing. It rose again on the news. Alphabet's market cap surged to nearly $3.8 trillion.
Rapidly closing the gap on second place.
Right. And this is all a reflection of what we talked about, smart spending. You have to look at their capital expenditure ratio. Google's projected Capex is huge, between $91 and $93 billion.
But that's only part of the story, isn't it?
It is. Because of their enormous revenue, that huge number only amounts to about 23% of their projected revenue for the year.
Okay, so why is that 23% number so important compared to their rivals?
Because if you look at Meta and Microsoft, they're also spending like crazy, but their Capex is hitting 35% of their revenue.
Which is much riskier.
Much riskier. If there's any kind of economic slowdown or if the AI returns don't materialize as quickly as hoped, the company spending 35% of its income is in a much tougher spot. Google has this huge revenue shield protecting its investments.
And they have the cash to back it up, too.
Their balance sheet is pristine. They have the most cash net of debt of any of their peers. Their total debt is only about 0.4 times their pre-tax earnings. For Microsoft and Meta, that number is 0.7. So they have the flexibility to just keep going no matter what.
And that Meta deal, when you see it in that context, becomes the ultimate proof point for their whole merchant silicon strategy. You should probably define that term. What exactly is merchant silicon?
It's just a term for a company deciding to sell its own in-house custom-designed hardware to outside customers. In this case, Google selling its TPUs.
Which they never used to do.
Never. They were for internal use only. By launching this strategy and selling them to Meta or Anthropic, they are now competing head-to-head with Nvidia in the open hardware market. It validates their entire approach.
Okay, so let's tie this all together. The big showdown, the ultimate meaning of this, it all comes down to specialized economics, doesn't it? And this key metric, cost per token.
That is the heart of the financial war. We always talk about speed, but for these hyperscale companies, the number that dictates profit or loss is cost per token. The total cost, power, cooling, the chip itself to generate one single unit of AI output.
A word or a pixel in an image.
Exactly. And how does the Ironwood TPU attack that number?
It's specialization.
It's specialization. Because it's only built for that one kind of math, its performance per watt is just better for these specific tasks than a general-purpose GPU. That directly lowers the total cost of ownership. And by selling it to others, Google is essentially offering everyone a way to escape the Nvidia tax.
Now, to be fair, Nvidia still has a huge moat, right?
Right.
CUDA is still the industry standard for R&D. That lock-in isn't going away overnight.
No, it's not. And that's a great point. CUDA is the language of AI research. It will absolutely remain dominant in labs and universities. But for a company at the scale of Meta, the sheer force of economic efficiency eventually wins.
The savings are just too big to ignore.
They're too big. When you're running inference for billions of users, a tiny reduction in your cost per token adds up to billions of dollars in savings a year. The market reaction shows that investors now believe Google is going to win that long-term war for profitability.
And if you needed one last final stamp of approval on that idea from the most unlikely of places.
You got it from Berkshire Hathaway. In the middle of all this AI bubble panic, they made a rare move and disclosed a new multi-billion-dollar stake in Alphabet. Almost $5 billion.
Which is about as powerful endorsement as you can get.
It's a massive vote of confidence. It tells you that even the most cautious, value-focused investors see Google's integrated stack, their custom TPUs running their own Gemini models, as the most sustainable and superior path forward.
So the market has spoken. That $4 trillion reaction, with Google soaring and Nvidia stumbling, it confirms that complete control over your own AI destiny is now the gold standard. The choice is no longer just which Nvidia chip to buy. It's Nvidia's ecosystem, or Google's specialized economic model. So here's the thought to leave you with. If cost efficiency and vertical control are the ultimate metrics for AI dominance, does this force every major tech company to build their own chip or risk falling permanently behind those who command their own infrastructure? Something to chew on. Before we wrap up.
We are not certified financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please consult a certified financial advisor.